Hello everyone, I'm Patrick Fross with Fross and Fross Wealth Management, and welcome to our market update video for the week of July 6th, 2026. Have you noticed how every time there's a big IPO, it suddenly feels like everyone's talking about it? Lately, a major company in the aerospace industry made its public market debut, and I've had several clients ask, should I be buying it? Or did I miss my chance if I didn't get it at the IPO price? Well, it's a great question because there's a pretty big difference between what we hear in the headlines and what actually happens behind the scenes. An IPO, or initial public offering, is simply the first time a privately owned company offers shares to the public for ownership. But here's what surprises most people. When you hear a company priced its IPO at, say, $75 a share, most investors assume that they could have bought it for $75. In reality, that's usually not the case. Before the stock ever gets started with trading, investment banks work with the company to determine that IPO price. And those shares are typically allocated to large institutional investors like mutual funds, pension funds, and insurance companies, not the average investor. By the time you and I can buy shares through our brokerage account, the stock is already trading on the open market, and the price may be much higher, or in some cases lower than the original IPO price. That's why IPOs can be so volatile during those first few days. There's a lot of excitement, a lot of speculation, and very little trading history. Now, some IPOs become outstanding long-term investments. Others do not. The challenge is that nobody really knows which will be which in those early days, no matter how exciting the story may be. It's also worth remembering that when a company goes public, the money raised isn't always used to fund that big vision you hear about in the headlines. It may also be used to repay debt, provide liquidity for early investors, or support the company's ongoing operations. So what does this mean for long-term investors? Well, for most of our clients, not much. Our investment philosophy has never been about chasing whatever stock is making headlines this week. It's about building a diversified portfolio that's designed around your personal goals, your time horizon, and your tolerance for risk. And here's something many investors don't realize. If that newly public company continues to grow and eventually becomes part of a major market index like the S&P 500 or the NASDAQ, there's a good chance you'll end up owning it anyway through diversified mutual funds or ETFs, or even the actual stock in direct indexing. In other words, you don't necessarily have to be first in line on an IPO day to benefit from a company's long-term success. The bottom line is this: headlines can be exciting, but successful investing is usually built on discipline, diversification, and sticking to a long-term plan, not reacting to whatever is dominating the news this week. As always, if you have any questions about something you've seen in the financial news, or you'd like to discuss how your portfolio is being positioned, we'd be happy to help. Once again, I'm Patrick Fross with Fross and Fross Wealth Management. Thanks for watching, and have a great week.